Yeah, hello, folks. Welcome to Kudlow. I'm Larry Kudlow. So I've already spent a couple days beating up on Joe Biden's terrible and dishonest big government socialism State of the Union message. And we're going to talk in a few minutes with Congressman Byron Donalds and Steve Moore about Joe Biden's dishonest distraction about Republicans cutting Social Security and Medicare. It's dishonest because not true. And it's a distraction because he'll do anything not to talk about Republican efforts to restrain his inflationary spending spree of the past 2 years. I mean, Biden, of course, never mentioned his debt talks with Speaker Kevin McCarthy. So who knows whether there's going to be a second meeting or another date, or they're going to hit a drive-in movie together, or maybe even a serious negotiation. Right now, Biden's not serious. He doesn't look serious, doesn't sound serious. And that's why his polls keep dropping. In fact, it's why polls are showing nobody really liked his speech. It's very interesting. He had a, quote, very positive reaction of only 38%. And to put that into context, Barack Obama had 50%, George W. Bush had 53%, and Donald Trump and Bill Clinton both had 54%. That's very positive reactions to their State of the Union speeches. So you know what? Mr. Biden at 38%, he's not kidding anybody with his antics, and it ain't going to work. So I'm going to set that aside for a moment. I want to turn briefly, and I want to be a little technical about another key topic, the Federal Reserve, that is fighting inflation. Now, I am worried the Fed's going to overdo it. The latest Fed mantra, echoed, of course, by Wall Street, is that the central bank has to tighten much, much more because financial conditions are easing. And I want to say this is nonsense. Now, for one thing, as Joe Lavorgna has pointed out, the Fed is focusing on the wrong measure of financial conditions. The recent rally in stock prices and the decline in longer-term interest rates does not mean the Fed is failing. In fact, ironically, it means the Fed is actually succeeding in reducing inflation fears and the actual inflation rate. And that's why bond yields have dropped. And one reason stocks have improved, really going back to last October. And one of our guests tonight, Ed Yardani, has been writing about this. But look it, I don't want to be too technical. I don't want to get in the weeds too much. But I think this is an important topic. The Fed rate hikes have actually jacked up household consumer borrowing rates. Look at the accompanying chart. You're over 7%. This includes things like credit cards and mortgages and personal loans and student debt. And over 7% puts it back to the financial meltdown recession in 2008 and 2009. It shows that financial conditions for consumers are very tight. They're not easier, they're tight. In addition, the Federal Reserve survey of bank loan standards shows a big tightening in lending standards for C&I commercial business loans, and the same for commercial real estate loans. That's the stuff the Fed should be looking at. And those lending conditions are already sufficiently tight. That's what the Fed should be looking at. Now, let me add a couple more pictures for you, then I'll be done. You can see the crash in the M2 money supply. You can see the plunge in the index of leading indicators. These are powerful recessionary signals. Disinflationary, yes, but recession also. Finally, we have a picture of the CRB commodity index, which shows a big drop-off last spring. And look how flat it's been at that lower level for about 6 months. Now, these commodity indexes are a leading indicator of future inflation. And they also show that the commodity value of the dollar is now steady and stabilized. That is the real value of the dollar. Used to be a discipline to people like Wayne Angell and Manley Johnson on the old Federal Reserve Board under Ronald Reagan. Now, another positive sign for lower future inflation. This is this stable dollar, low commodity. So, look, the Fed may have a little more work to do on getting their target rate up a wee bit more. But if they don't look at the right indicators, they're going to make another very big mistake. And looking at financial conditions just because bond rates have come down is the wrong idea. I know some very smart economists who are talking about that, and they shouldn't. Finally, speaking of mistakes, if Joe Biden weren't such a discipline of Bernie Sanders, he would understand why raising taxes and chronic overregulation from his posse of central planning bureaucrats is doing great harm to the economy. You know, it may sound great for Lenin or Fidel Castro or Xi Jinping, but blaming rich people and blaming businesses will not incentivize the kind of investment that our economy needs to grow. So here's a thought. President Biden, guess what, sir? It is businesses who hire people, and it is businesses who pay them. Your trouble, sir, is you like employment. You just don't like the employers who hire them. So I'll conclude tonight, save America, help business for a change. How about that? You'll also be helping middle-income, blue-collar working folks and their families.